the time we meet for a group accounting session, that is advanced financial reporting paper. We are going to do a question whereby a subsidiary had been disposed entirely at the end of the year. So before I move to that question, remember that when a parent acquires a subsidiary, that is okay. Then later now, to make it advanced, the examiner will come and mention that this subsidiary was later disposed. So you can say that the disposal was entire, of which the entire disposal occurred at the end of the year when you are preparing your books, or the disposal occurred during the year, or the disposal occurred during the year. So it can be at the end of the year or during the year. Or there can be a partial disposal, whereby the subsidiary had been disposed and it remained to be a subsidiary, or it changed to be an associate, or to be a joint venture. So for this session, I will introduce a part whereby the disposal was entire, and to be more specific, what happens when the disposal occurred at the end of the year, or when the disposal occurred during the year. What are you supposed to know? What are you supposed to do? What statements are you supposed to do? In which way are you supposed to prepare them? So let us go through the scanned notes so that you can be able to understand what I'm talking about. So these are the scanned materials. These are the scanned notes. They are talking about disposal. They are talking about disposal. So it can be either an entire disposal. It can be either a partial disposal with the subsidiary remaining to be subsidiary, or it can be a partial disposal of the shareholding, the subsidiary, with the subsidiary becoming an associate or a joint venture, with the subsidiary becoming an associate or joint venture. So you can see we are saying that IFRS 5, discontinued operations and assets held for sale. So the discontinued operations, that is the discontinued operations, the discontinued operations. So that is, we say that a parent company may dispose of its shareholding in the subsidiary company for several reasons. So disposal may take place in 8 of the following ways. So I've talked about it: entire disposal of the subsidiary, entire disposal of the subsidiary, entire disposal of the subsidiary. That is entire disposal of the subsidiary, of the shareholding in the subsidiary, whereby when there's an entire disposal, I initially mentioned that disposal can be during the year or at the end of the year. Then we have partial disposal of the shareholding in the subsidiary, with the subsidiary remaining to be the subsidiary. So remember, for example, if the parent initially acquired a subsidiary of 80%, it will come and dispose a certain percentage, and maybe it reduces to 60%. Remember, again, 60% is just a subsidiary. Then we have partial disposal of the shareholding in the subsidiary, with the subsidiary becoming an associate, or it becomes a joint venture. It becomes an associate or a joint venture. So to start with, we are going to talk about this entire disposal of the shareholding in the subsidiary. So as I have just mentioned, the way I've just explained. So what you need to know is that when disposal occurred during the year, let's say, for example, a controlled A controlled B, or A controls C, or A controls D. So A can be controlling various entities. So I would like to write on the whiteboard so that you can be able to understand what I'm explaining about. So let me turn to the So when we talk about this disposal, entire disposal, so that is okay. So when we talk about entire disposal, so I'm using an example whereby, let's say, entire disposal at the end of the year or during this year. And this is on a scenario whereby A had acquired, let's say, B, C, and D. Then this one, let's say this one was 80%, this one was 50%, and this one was 30%. That percentage of control was that way. So 80%, 50%, and 30%. So I'm starting with an example whereby now this subsidiary was disposed entirely during the year. Then A acquired another entity. Let's say he acquired E, 75%. So he disposed B entirely during the year. Let's say at the middle of the year. He disposed B at the middle of the year, entire. Let's say at the middle of this year. Then he acquired, so this one was before disposal. This is the structure before disposal. Then we will have another structure after disposal. Another structure after disposal. So I've said that A will be remaining now with, he acquired E, C and D will be there. So on the same date when he disposed B, he acquired E, let's say 75%. So this one will remain to be 50 and this one will remain to be 30. So which means that these companies, E, C, and D, were there to the end of the year. They were present to the end of the year. But the right of B was terminated during the year. It was terminated at the middle of the year. So what are we supposed to do on this scenario, my good students? So what you are supposed to do on this case, remember that B will be considered as a discontinued operation. It will be considered as a discontinued operation. B will be considered as a discontinued operation because its life was terminated by this period. So which means that in this year, it existed for only 6 months. So what you are supposed to do, you will prepare a separate income statement for B for 6 months. Then you will come and prepare another income statement for E, C, and D. But putting in mind that E was again present for 6 months. So which means that when you are doing your income statement, you have to apportion the items of E proportionately according to the 6 months it was existing. Then C and D will be obviously accounted as associates and joint venture, of which for now you know. So what am I trying to imply? So what I'm trying to imply is that when there's disposal, and this disposal of the subsidiary takes place during the year, and to be specific that it's an entire disposal, you have to prepare 2 income statements. The income statement of a subsidiary, the income statement of that subsidiary, which was disposed entirely during the year, which will be considered as a discontinued subsidiary. Then you would have to prepare another income statement for the other entities, for the other investee companies, which were existing until the end of the year. That is what they did here. That is why you can see these statements given here. So there's this income statement for the continuing, the one which were present until the end of the year. So this is an example which they are giving you the relevant statements you are supposed to prepare when the disposal occurred during the year. So they have provided, or now you are supposed to prepare the relevant income statement. But for now, you know how to prepare income statement. So what you need to know is that there is a continuing operation and a discontinued. And I think you have understood what is a discontinued operation and what are the continuing operations. For the preparation of the income statement, they will remain the same thing, you know. It's only that now you need to know, or to make specific, is that when you will be doing your continuing income statement, you will only consider those investee companies which were present until the end of the year. So the one which were present until the end of the year. Right now, on the example I provided, the E which was acquired, C and the D. Those are the ones to consider under continuing. Then you have to prepare another income statement for the discontinued operation. So the discontinued operation now is that income, is that subsidiary which was disposed entirely. Is that subsidiary which was disposed entirely during the year. So you need to consider it for the months it was existing. Like now B, I said it was existing for 6 months. That is from January until the date it was disposed. When you are doing disposal, when you are doing your disposal, there's a main account you have to prepare. You have to determine. Remember that when you dispose something, you have to determine either you got a gain or you got a loss. Either you get a gain or a loss. So how do you determine now when there's this, if there's a gain or a loss under disposal of the subsidiary? This is the relevant format to use. So we start from the sold proceeds. The proceeds you got when you disposed your subsidiary. You minus the net assets disposed. Net assets disposed. These are like ordinary share capital, share premium, retained earnings, revaluation reserve. The equity components which were present on the investee companies which was disposed. That is what you minus. The share of net assets disposed. Then you consider again, you minus the unimpaired goodwill disposed. The unimpaired goodwill disposed. So you know how to compute goodwill. So the unimpaired one, but disposed. Then you determine dividend earned or disposed. The dividend earned or disposed. You consider the dividend earned or disposed. Then I could try now to do this common question, and it was tested in December 2017, question 1, so that we can be able to express more what a student is supposed to do when there's this aspect of disposal. But now I will never start with disposal during the year, but I will start with disposal at the end of the year, of which I need to emphasize again a bit that now what if disposal was at the end of the year? What if it was at the end of the year, not during the year? Because what I've mentioned is all about when disposal was during the year. What happens? What if the disposal occurred at the end of the year? What is supposed to be done? Let's say, for example, A had acquired B, he had acquired C, he had acquired D. Then this B, let's say it was an 80%, this one was 50, and this one was 30. The B was disposed entirely. This B was disposed entirely at the end of the year, let's say 31st December. What are you supposed to do? Does a discontinued income statement being prepared, are you supposed to prepare discontinued income statement on that scenario? No, because on this relevant year, that subsidiary which was disposed was present until the end of the year. Disposal only came in at the end. What the examiner needs is that you prepare an income statement for the year. So which means that even if disposal occurred at the end of the year, our subsidiary for the current year, when you are told to prepare your income statement, the subsidiary was there for the entire period. So there's nothing like discontinued operation when there's an aspect whereby the subsidiary is disposed at the end of the year. So which means that when disposal occurs at the end of the year, there's no much effect to the income statement. You only do your normal consolidation, just taking the parent plus that subsidiary. It was there for the entire period. The only thing which you would check for that disposal is either we got a gain or a loss on disposal. And if it's a gain, it's an income. If it's a loss, it's an expense. So this is the question. This is the question. I call it a common question because this is the only question when there's disposal at the end of the year. When there's disposal at the end of the year. So they were saying that it's a question of 2017, December. So you can check if you have the past paper. They were saying that the following statement of comprehensive income relates to W Limited and H Investing Company, S Limited, and F Limited for the year ended 31st March 2017. So you have the statement of comprehensive income for W, S, and F. We don't read income statements. You know what is contained there. So additional information. W Limited bought 60% of the holding in the equity shares of S on 1st April 2016, which is okay. The purchase consideration was agreed at 900 million, of which 600 was paid in cash. The balance was satisfied by immediate issue of a 5% bond at par. S Limited's net asset had a fair value of 1,400 million as at 1st April 2016, represented by equity share capital of 775 and retained earnings of 625. It was decided to apply the proportion of net asset method to calculate goodwill on acquisition. No impairment loss on goodwill arose during the year ended 31st March 2017. W Limited sold its entire 60% equity holding of S on 31st March 2017. You can see that initially note 1, W bought 60% holding in the equity shares of S on 1st April. But in note 2, you are told that W Limited sold its entire 60% equity holding in S on 31st March 2017. That date is very important. For shillings, 1,150 in cash. No entry has been made to reflect this transaction. Number 3, W Limited owned 90% of the equity shares of F since incorporation. No goodwill arose on this acquisition. There were no retained earnings in existence as on the acquisition date. During the year ended 31st March 2017, W Limited sold goods to F for shillings 15 million. These goods were sold by W at a markup of shillings 50 on cost. 3/5 of these goods remained in the inventory of F as at 31st March 2017. An amount of shillings 4.3 million remained outstanding to W Limited in respect of these goods as at 31st March 2017. Number 5, on 1st March 2017, F declared an interim dividend of shillings 9. W Limited has recorded its share of this dividend as income No other dividends were declared by the group companies during the year ended 31st March 2017. All expenses and gains are assumed to accrue evenly throughout the year. No new equity share capital was issued by any group company during the year ended 31st March 2017. Interest on the 5% bond was payable in arrears. No payment has been made or provided for. And this one reminds me that when I was doing my section 6 CPA, this is the sitting I did. This paper is the paper I did in the advanced financial reporting. So required the gain or loss on disposal of shares in S Limited, consolidated statement of comprehensive income for the year ended 31st March 2017. 2017. So it was a very simple question. It can't take a lot of time because it's not wide. So what you are required to do here is all about, first thing, in any question of group at your level, advanced financial reporting, you need to check, is this a question, a direct question? When I mean a direct question, it's like a question of receipting. There was no disposal. It was like a question of section 3. So that one was a direct question. You were told just they acquired, that's all. Then you are given the additional information which we have been going through now and then. But now, when it's more of a now advanced, you will find that there's an aspect of disposal. After acquisition, they disposed. So as a student, you need to identify when was this disposal, or how was this disposal taking place? Was it an entire disposal? If it's an entire disposal, my financial year was running from which period to which period? So that once you draw that line, you will be able to know, is this disposal occurring during the year or at the end of the year? That is the case when there is entire disposal. You need to know that timing. Your financial year is running from when to when. Then you go back to the entire disposal, you check when it occurred, so that you can see if it's at the end or during the year. The next thing, a disposal can be partial. So again, you check if it's partial. How did this partial was occurring? Did the subsidiary remain to be a subsidiary? Did it change to be an associate or joint venture? You know all of the concepts. If it's changed to an associate, you know now to account for associate. If it's changed to be a subsidiary, not changed even. If it remains to be a subsidiary, it's just a percentage. You will change on some workings you will do. If it's changed to be a joint venture, you know how to account for joint ventures. Joint ventures are accounted the same way as associates. All right, let's do this one so that anyway, we see what we can do in the remaining time. So the first thing you do is all about, now we check, because according to the question we have read, it was an entire disposal. So since it was an entire disposal, I said now you have to check when was the financial year ending and when it was starting. So in short, you were told to prepare your books by which time? So our statement, the statement we are supposed to do is as at 31st March, 2017. 31st March 2017. So the 31st March 2017. So which means that it starts on 1st April 2016. You know how to determine that. So our financial is ending March. So after March, it's April, but now 2016. Then it was which company acquiring which company? It was W acquiring two companies, that is S and F. it was W acquiring S and F. As told in note 1 and note 3. Note 1, you are told W acquired or both, 60%. So you draw that structure. So W both. So W both S remittent, and as told in note 3, it both F remittent. Note 1, it both 60% of S, and note 3, you are told W remitted owned 90% of the equity shares of, it owned 90% of the equity shares of F since incorporation. So we never know from which period. So we assume that it was some times back, which means that that F will be present for the current year when we are preparing our books for the entire year. So after that, I said, now you check, when was disposal taking place? Or was it disposal partially, or was it an entire? According to note 2, you are told that W Limited sold its entire 60% equity share, equity holdings, not equity shares, but equity holding in S Limited on 31st March 2017 for 1150. So on which date? 31st March. 31st March is at the end of the year. Is at the end of the year. So which means that S was disposed at the end of the year. And since it was disposed at the end of the year, this implies that there's no effect to the income statement. When you would be preparing your income statement, considering S and F, they will be present for the entire period from 1st April to 31st March 2017. But for S, maybe the working which I'm supposed to do due to this disposal, it's all about a gain or a loss on that disposal. And this gain or loss on disposal, this gain or loss on disposal is what the examiner went ahead to ask the students to compute in our first requirement. That is number 1, the gain or loss on disposal of shares in S on 31st March 2017. I think when I was introducing the topic, I mentioned about the formula to use. So you use the following formula to determine the gain or loss on disposal, the gain or loss on disposal. So you start from sales proceeds. You start from the sales proceeds. So then after that, you raise the unimpaired, you raise, before we talk about unimpaired goodwill, I can talk about the share of net assets disposed, share of net assets disposed. Then after that, you raise unimpaired goodwill, unimpaired goodwill disposed. Then after that, you raise dividend earned and disposed. Dividend earned and disposed. So this is the formula you will be using. In some questions, it would be just a working. In some questions, it would be just a working. But for this question, it is a requirement. So sales proceeds, when they sold, that is when the parent sold this subsidiary. When he sold this subsidiary, I think the amount which he received, anyway, the amount which he received according to note 2 was 1150. W sold its entire 60% equity holding in S on 31st March 2017 for shillings 1150. For shillings 1150. So 1150 is what you record under sales proceeds. Then you raise the share of net assets disposed. So if there could have been a statement of financial position, we could have just checked direct under the equity part of the statement of financial position. But now, since this question doesn't have a statement of financial position, what the examiner did, he went ahead to provide those net assets under the additional information. So additional information number one, you were told W Limited bought 60% holding in the equity shares of S. In the equity shares of S on 1st April 2016, the purchase consideration was agreed at shillings 900, of which 600 was paid in cash. So that is all about purchase consideration. What about net assets? Let's just go to this sentence in between here. So they say that S Limited, so that we don't read everything. So S Limited, there's somewhere here where my cursor is, they are saying that S Limited net asset had a fair value. Net asset, you can see, had a fair value of 1,400. Represented by what? Equity share capital of 775 and retained earnings of 625. So the two, if you add 775 plus 625, they are supposed to give you the 1,400 because they are saying that is a representative of that. The two, equity share capital and retained earnings, represented the 1,400. So when I will be looking for the share of net asset disposed, those are the two I will use. But for the retained earnings, I have to be a bit specific that the retained earnings must be the one which was as at the disposal date. Let us do the working here. So we are looking for the, so now here arises whereby there's a working inside another working. So this one now you would find that a serious consolidation is coming in. So share of net asset disposed, of which I said in a question, in another question, this can be a working, of which this will be a working inside another working. So the share of net asset disposed. So we have ordinary share capital and we have retained earnings. So this one was 775. But for retained earnings, when you are doing this disposal, the retained earnings must be as disposal date, of which you can see that the 625 is not as disposal date because the disposal date was at the end of the year. But those net assets are provided as at 1st April 2016 because the 1,400 was as at 1st April 2016, which is not as at 31st March. So we have to look for the retained earnings as at 31st March. So what you do, you will come here and draw this line. You say 31st March 2017, 1st April 2016. So this one was 625. 625 was as at that date, at the start of the year. We need the retained earnings as at disposal date, which is the end of the year. So if this is the retained profit, this is just a retained profit. So what you do in order to get the retained profit as at the end of the year, you check the profit for the year is from the income statement. Our profit for the year was so was this. So you can see here we have a profit after tax for the year 90. That is for S. Remember that we are dealing with S. S is the one which was disposed, plus other comprehensive income. So in short, the total comprehensive income for the year is our profit for the year, 102. The 102 as per the income statement. So in short, you can get the profit as at 31st March. So you take 625 at the start, you add the 102. Someone, what are you getting? The answer there is 625 plus 102. So 620.
727.
That is 727. So that is 727. So add the two. 775 plus 727. So I'm getting here 1502. That is according to my calculator here. But what we need to know is that the parent never controlled S fully. So in order to get what is disposed, he controlled S up to 60%. So 1502 times 0.6. You can see I'm getting 901.2. So he disposed the entire 60. Because 60 was the shareholding which was acquired initially. Then they disposed everything. That is why I'm just multiplying the figure 1502 by 60. And that is what they disposed. So that is what we record here. 901.2. An impaired goodwill disposed, we have to look for goodwill. So we need to use the full method or the partial method. There's this aspect of fair value of the NCI. For you to use the full method, there's that aspect of the fair value of the NCI, that is non-controlling interest, which is supposed to be provided. So on this question, if you go through your note one, there's something they mentioned on how we were supposed to get that fair value of the NCI. It was never given direct. If you read the last sentence of note one, they said that it was decided to apply the proportion of net asset method. The proportion of net asset method to calculate goodwill on acquisition. The proportion of net asset method. So which means that on this scenario, I would be using full method due to that statement, on which my purchase consideration is 900, the total. Even if the balance was paid through a bond, for now we know that the purchase consideration, the total is 900. For you to get now this fair value of NCI, you use the proportion of net assets. So S was acquired up to 60. So NCI is 40%. And the net assets of S is 1,400. Proportion of net assets. The net asset is 1,400. As per note one there, you are given the net assets. So the proportion of those net assets, 40% of 1,400. You get 560. Then you go and raise the share of net assets. The share of net assets. So net assets, so the net assets we are supposed to raise, they are according to the note one. We were told the 1,400, the net assets, represented by equity share capital of 775 and retained earnings of 625. So what do you know is that equity share capital, this one is direct, equity share capital, this is like ordinary share capital, equity share capital. So equity share capital, that is 60% and 40%, 60% and 40% of 775. So 0.6 of 775. So that is 465. And we can just change this. So this is 40, this is 310. Then retained earnings. What do you know about retained earnings when you are doing goodwill? Retained earnings, you have to use the one which was present as at the time of acquisition date. But for this question, it was correct. It was as at acquisition. the retained earnings was as at acquisition, because we know that S was acquired on 1st April 2014, and the net assets of 1,400 was as at 1st April 2016, which is fine. So there's nothing to compute there. We just take 625, which is as at the acquisition date. So 60% and the 40% of 625. So 0.6 times 625. So 375. Then we have the other one is 250, the 40%. So you can deduct from your purchases and the fair value of NCI. So 900 minus 465 minus 375. So this is 60. What about the other side for NCI? 0. I can see that one. That one is 0, this one. So was goodwill impaired? Was the goodwill of these companies impaired? It was never impaired, because they mentioned that there was no impairment. That is the last sentence under note 1. No impairment loss on goodwill arose during the year ended at 1st March 2017. So this is the unimpaired goodwill, the 60. The 60 is the unimpaired goodwill. So that is what I'm supposed to record on my unimpaired goodwill disposed. So they disposed everything of that 60. Did S pay dividends? Because now the last thing which we are supposed to do is dividend earned and disposed. Did S pay dividends? So you go to your income statement first. After the profit after tax, you check if there's any dividends which was paid. I can't see any under the income statement, because after the profit after tax, what I can see is other comprehensive incomes. Before you conclude that there was none, you can check under additional information. In this question, if you go to additional information number 5, the only entity which declared dividend is F. They said that on 1st March 2017, F Limited declared an interim dividend of Sh9, but F was never. Remember that F is the one which was just acquired. It was never disposed. So they continued to say that W has recorded its share of this dividend as income. No other dividends were declared by the group companies during the year. So which means that S never declared. The only entity which declared dividends is F, but F was never disposed. We are not dealing with F here. Under again or loss on disposal, I'm dealing with S. So I will put dash under this. So if there was dividends, I could have just taken 60% of that dividends. If there was dividends which S paid, I could have taken 60% times the dividends which S paid, but there was none. So on this scenario, you subtract, you subtract, you subtract, so that you get a gain or a loss. So if it's a positive, it's a gain. If it's a negative, it's a loss. So that is 188. I'm getting 188 point. That is 188.8. So this is a positive, which is a gain. So after you are done with that, we move to the next requirement. So the next thing is all about now to do the statement of comprehensive income. Just a normal one, because the disposal of S was just at the end of the year. So that one doesn't qualify the S to be a discontinued operation. So if it could have been disposed during the year, that is when I could have considered it as a discontinued operation, and the others which were present up to the end of the year to be continuing. So we do an income statement. So W Limited is the one which is preparing the consolidated
consolidated income statement. So that is for the year. For the year ending, our financial year was ending when? 31st March. Eh? Uh, 31st March. So we have to start from revenue or maybe sales as per the question. So as per the income statement, that is so we have the parent is 976 plus the subsidiaries 420 plus 63. Then what you deduct under the revenue. So I have just added the 3 because parent subsidiaries, these subsidiaries were present for the full year. So what you deduct under revenue is only the intergroup sales between those entities. There was an intergroup sale under note 4. During the year ended at 1st March 2017, W sold goods to F for 15 million. So that is what you only deduct there. There is no another intergroup sales. So if you check 976, if you have done, you can give me the answer, plus 420 plus 63 minus 15. So this is 1444. That is 1444. Then after that, we talk about cost of sales. So the cost of sales. So the cost of sales is 687 plus 228 plus 26.2. You minus the 15, you add UPS. So after the deduction of intergroup sales again under cost of sales, you add UPS. UPS is just unsold goods on the recipient side. That is like now here, who is the recipient of the 15 million goods? The goods of 15 million, who received them? F, according to note 4. During the year ended at 1st March 2017, W sold goods to F for 15 million. These goods were sold by W. So when W was selling, he sold at a markup of 50%. But now, did F resell all of them? They said that 3/5 of these goods remained in the inventory of F as at 31st March 2017. So you know that UPS is all about unsold goods times profit margin. So unsold goods here is, what did they say? So they said 350. What did they mean when they said 350? Was it the one which was held? They said that 3/5 of these goods remained in the inventory. So that is the unsold, of which we can see markup is 50%. When the seller was making a sale, he sold at a markup of 50%. So 3/5 of 15 times a third. Why a third? Because 50% is a half. That is markup. To make it margin, you add this numerator to the denominator. So that is why I'm saying a third. 45 divided by 15, that is 3. So 3 is what you add here. And this is UPS on closing stock. This is UPS on closing stock. Because these goods of 3/5, these goods of 3/5 these goods of 3/5 were unsold. The goods of 3/5 were unsold by the end of the year. Were unsold by the end of the year. So after that, you think of depreciation, overcharge, and undercharge, but there was none. So if there was a depreciation overcharge, if there was depreciation overcharge, you raise. Then undercharge, you add. Depreciation overcharge arises when there's a sale of fixed asset, of which first we determine and realize the profit on that fixed asset by taking the transfer value at which the asset was sold times the profit margin. So we determine and realize the profit on fixed asset first. Then after determining the unrealized profit on fixed assets, obviously you would find that both of those entities who were transacting on that asset, they charge depreciation on that asset. So you determine your depreciation overcharge by taking the unrealized profit on fixed assets, you multiply with the relevant depreciation rate. But if you are provided with the remaining useful life, you divide. So you take your unrealized profit on fixed assets, you divide. Then for depreciation undercharge is due to revaluation. So up to this point, what are we getting? So 687 plus 228 plus 26.2 minus 15 plus 3. So this is 929.2. So 1444 minus answer. Is this 514.8 as a gross profit? So after getting that, we check the next thing. Consolidation is very, very easy and very enjoyable. Remember that there's companies which do these consolidations now using systems. I think you know. So we need another thing which is other income. Other income is just 6.1. That was a free mark. Then there's this aspect of dividend. Dividend received. So where was this dividend received from? 8.1. So if it's the dividends which were received from third parties, it's okay, we can record as dividend received. But if it was dividend received from our investee companies, which is S and F, that one you need to write it off. So which means that we need to check, did S and F pay dividends? We checked that enough. We know that note 5, they said F declared an interim dividend of 9, of which W recorded its share of this dividend as income. So 9 is what was declared. So this 8.1, you have to minus the 90% of 9, because this one was from an investee company. So we need to only record dividends from the third parties, not from investee companies. So if you take 90, that is around 8 point. So this is 0, because 9 times 9 is obvious 81. So 1 point there is 8.1. So we just record 0. So another thing is operating expenses. So the operating expenses, you can see it's 68 plus 54 plus what? Plus 13.4. So 68 plus 54 plus 13.4. So I'm getting 135.4. 135.4. Then if there was impairment, we could have introduced here. But now, according to our question, they said there was no impairment. Even if we calculated goodwill, we never impaired them. Because under note 1, there are sentences there. They said no impairment loss on goodwill arose. Even under F, you can see under which statement? There's this statement 3. W Limited owned 90% of the equity shares of F since incorporation. No goodwill arose. So even under F, there is no even goodwill. So we cannot even have impairment because there is no goodwill. So up to that point, we have a profit before interest and tax. Then interest is all about finance cost. So the finance cost, you can see we have 12 plus 8, 18, not 8, plus 6.2. Then we need to consider again, we need to consider here the balance. The balance, remember that they said that the balance of the purchase consideration was paid by a bond. So the purchase consideration was 900. That is note 1 I'm reading. I'm trying to talk about note 1. So the total purchase consideration was 900, but 600 was paid in cash. So the balance is 300. It was paid through a bond, which attracts an interest of 5%. So 5% of 300 is 15. So 15. So if you take 12 plus 18 plus 6.2. So what you are supposed to add there is all about the 5% of the 300. Because now the balance of the purchase consideration was through bond. And they say that the bond was stated at 5%. So which means that there is an interest on that of 5%. So you need to add there. So 12 plus 18 plus 6.2 plus 0.05 times 300. So I'm getting 51.2. 51.2. Then remember that on this scenario, there was no associate, there was no joint venture, but the only income which I have not recorded, it's the gain on dispose of S. So we need to record it before we charge tax. The 188.8, we need to record it before we subject this relevant amount we will get to tax. So up to that point now, I can freely say that what is the value for profit before tax. profit before tax. Then I say I minus income tax. So the income tax of the three companies, parent and its investee companies. So income tax is 45 plus 30 plus 3.2. So 45 plus 30 plus 3.2. That is, I'm getting from my end 78.2. So profit after tax. So if someone has done the computation, which is the profit before interest and tax figure? Someone who has done those totals. So I can get here is 385.5. So minus 51, minus 51.2 plus 188.8. That is 523.1. You minus 78.2. I'm getting 444.9. Then after that, we talk about another thing, maybe which is remaining on that income statement. So we come and say other comprehensive income. So that one you need to apportion it proportionately as per the percentage of control. Other comprehensive income. So other comprehensive income 15, 12, and 2. 15 plus. So this is just a revaluation. Again, so we have 15 plus 60% of 12. Then we add the 90% of 2. So this one I'm getting 24. So total comprehensive income. So if I add 444.9 plus 24, that is 468. 468.9. Then I will come here and say profit attributable to NCI. Profit attributable to NCI, then profit attributable to parent. So remember that the profit attributable to the NCI, that one will be based on the profit. It will be based on the profit of those subsidiaries. So after the subsidiary, let's say S and F, they have paid tax. So the profit after tax of those subsidiaries, you know that the parent never controlled them 100%. Like now, S was controlled up to 60 and F was controlled up to 90. So after they have paid tax, after S has paid tax, they start profit, it remains with. So it has to share 40% to NCIs. The same for F, after F has paid tax, it has to share 10% to the minority shareholders. So which is the profit after tax of S, and which is the profit after tax of F? So we have 90 and 14. I know there's a question which you might be having in your mind. Why did I apportion 60% here? And why did I apportion 90? Because you can see when I'm sharing this profit to the NCI, I'm using the profit after tax, not total comprehensive income. I'm using the profit after tax. So which means that we have to consider the revaluation gain only for the case from the perspective what the parent is getting from those entities. Because for determination of profit after tax in NCIs, I'm using the profit after tax, not total comprehensive income. So I cannot share direct the 90% with 40, not the 90%, but the 90 with the 40%, and the 14 with the 10. So before we do that, we have to adjust this profit. Maybe they are overstated or understated. Why can they be understated or overstated? If there's an aspect of UPS upstream, due to an upstream sale, if there was a depreciation under charge, remember that we never deducted, so it was overstating profit, so we need to deduct. If there was depreciation overcharge, if we did an overcharge, we had understated our profit. So we need to add back the depreciation overcharge because we had understated our profit with that overcharge. Then finally, if there was impairment, remember this one, it arises later when there's a goodwill, that is when we impair. So it's an expense which has been introduced, but it has not been accounted for anywhere. So that is why we always raise. And for you to use it, when you are doing your goodwill, you must have used full method. So the UPS was there, but was the sale upstream or downstream on the goods which were sold? Who sold to who? That is according to note. That is according to note 4. W is the one who sold, which means that that is a downstream sale. There's nothing like this one. Even undercharge was not there because there was no revaluation. There was nothing like revaluation. Even overcharge was not there because there was no sale of fixed asset. For you to get depreciation overcharge first, you have to think of a sale of fixed asset. Even impairment, it was not there. Even if we computed goodwill, in the question, they never said that we impair. They never mentioned about impairment. So which means that it will remain to be 90 and 14. But now if those items were present, that is what you could have done. That is what you could have computed. So it remains to be 90 and 14. But now the 90 and 14 is the adjusted profit. So to get the NCI profit, you have to take 40% of the 90, you add with the 10% of the 14. So according to my calculator, I'm getting 37.4. So that is what you put here. So that the profit going to the parent you take the total 468.9, you minus 37.4. You minus 37.4. So 468.9 minus 37.4. So 431.5. And that one marks the end of that question for December 2017. So there's this equation now, after we are done with this aspect of disposal occurring during the end of the year, that is, after we are done with this question whereby disposal was taking place at the end of the year, we have to go and do a question now when there's disposal during the year. So this is the relevant question. This is a question of 2010. So this question of 2010, you are told that head sold its entire shareholding. He sold the entire shareholding of 80% in shoulder. And acquired 75% of the shares of STEM during the year ended 30th September 2010. Head Limited also acquired 40% of the shares of Angle Limited. So what you need to know is this. Here they are trying to challenge a student because there's no way you can dispose something today which you don't own. Let's say you have a vehicle, you are selling it today. You acquired it some times back. That vehicle was acquired sometimes back. So that is why you can see I went ahead when there was a technicality of sound. I went ahead to mention about this information which is here. remember that you can see, even if they said that first they disposed, what you need to know is that shoulder was acquired sometimes back. So as told in the additional information, Head Limited had acquired its shareholding of shoulder at a cost of 2,200 on 1st October 2007. On 1st October 2007. When was disposal took place? On July. On July. So which means that acquisition even was there before 2007. That is 2007. Before they disposed in 2010. So that information at the start of the question is kuchanganya. Ni only that they are trying to check your mind that did you know what you are supposed to do here? So acquisition of this shoulder was there sometimes back before they disposed. On 1st July, Head sold its investment in shoulder at a price of 3,000. That is 3,040 shillings. So even you can see, even stem and angle were acquired even before this shoulder was disposed, because right now stem was acquired in January 2010. Angle was acquired in April 2010. Cost of purchase is given, ordinary share capital is given, fair value of non-controlling interest is provided. This one will assist you to use full method when you will be checking for the goodwill of stem. Even when you will be doing again the goodwill of a shoulder, you will use full method because you are given the fair value of non-controlling interest of shoulder. Which information again do I have to mention here? There's nothing else. Because like now note 4, they say during the year, the companies traded as follows. So this is just intergroup sales. You determine your UPS. Number 5, goodwill of shoulder had been impaired by half on 1st January, so that is impairment. So the main thing here you need to check again is all about, did this disposal occur during the year or at the end of the year? Our financial year ends on, you can see it's ending on 30th September. 30th September. But the disposal of a shoulder was on which date? July 2010. It was on July 2010. So which means that it existed for many months during this year. Because our financial year starts on 1st October. From October now to July, October, November, December, those are 3 months plus the 9. So you have to prepare an income statement of shoulder, only shoulder, for 9 months. That is an income statement you prepare for 9 months as a discontinued operation. Then you have to prepare other income statement for these companies here. For stem and ankle. So for stem, remember stem, you have to check when it was acquired because it was there to the end of the year. So stem is now a continuing operation and ankle is a continuing operation. So stem, when you will be preparing your income statement, you consider it for 9 months because from January to the end of the year to September. Then for ankle, from April to the end of the year. So that is what it is. You have to do 2 income statements. The one for discontinued, which is shoulder, and the one for continuing, which is stem and ankle. And that is what I will be doing in our next session. And that one marks the end of the session today.